here we go. Number 1 is false. You can just handshake, but it's a really good idea to have it in writing. Number 2 is true. It's usually agreed upon at the time of the formation how they are going to divvy up like values of non-cash assets and what their ratio is going to be and whatnot. Number 3 is false. Why? More so because of the dollar amount. So Hampton invests the following assets in a new partnership. $30,000 cash. Cash is cash. We better let that value stay. The equipment that costs $70 but has a book value of $34 and a fair value of $40. The dollar amount of the assets going in is $70,000. $30 plus the fair value. I had a couple conversations yesterday about what's the difference between book value and fair value. Book value is like on paper, on purpose, what its value is. Fair value is what the partners decide upon they feel is fair. Okay, that answer is actually $70,000. That's why it's false. 4 is false. 2 proprietorships can combine a partnership. Number 5 is true. As partnerships are formed, there are 2 contra assets that offset asset valuation. Accumulated depreciation does not go to a new partnership. It gets absorbed and revalued at what we'd call fair value of that asset. What contra asset does tag along though to a partnership? It's a contra asset, allowance for doubtful. If we have AR balances sitting there and there's a contra asset devaluing them, that typically will tag along to a formation of a partnership. 7 is true. Any questions on that? Oh, 6 is false. 7 is true. 8 is true. A partner's drawing accounts are closed into capital, not the income summary. Number 9 is true. How do they differ though? Because that's the last question on this test. The financial, say that again, Ben? 2 capital and 2 drawing, very good. And number 10 is false. The liquidation of a partnership means a new partner has been admitted. We liquidate for one of 3 reasons. We either sell the business, there's a death, or there's a bankruptcy. Number 11 is A. A general partnership or an LP or LTD is typically going to have, I said that wrong. No, I said that right. General partners have no bubble. I was looking ahead on my answers. General partners have no bubble, unlimited liability, meaning once the business is professionally taking the hit financially, then they'd attack the person personally. Personal. Scary. 12 is C. 13, that's what I was getting ahead on. 13 is A. Limited partnerships are going to have one general partner without a bubble and potentially other partners with bubbles. That's where they stand for LT or LTD. 14 is D. If they say the fair value of the equipment's $120,000, originally cost $220, has accumulated depreciation of $60. Who cares? The fair value is what the actual recording of the journal entry is. 15 is C. Fair value again. And 16 is B. Do we need to illustrate why? Yep, I'll go through that. Hopefully my pen will write nice up here. You guys see that? Okay. We really don't care about Eli because it's just asking about Alex's share of net income. I think this is a poorly worded question because to me, it's salary plus net income, but what remains, but I'll still break this down. Eli had a salary allowance of 70, okay? Alex had a salary allowance of 35, okay? We were sitting there at 245,000 net income, okay? How much has been eaten up by salary allowances? Are you guys with me? How much have we paid them in salary allowances? Thank you. How much do they have left to share? 140, okay? This partner is 80%, this partner's 20%. So at that point, we're just looking for how much does Alex have left out of that 140? It's 20% of 140, which would be 28,000. In my opinion, we should add 28,000 to 35,000, which is also one of the answers. But they're really just asking, like, out of, we've already paid him, how much is left out of net income for him? Okay. I could argue one of two ways there. Did that help? Good. On to the next page. 17 is C. That is step 2 of 4. Let's review our 4 steps of liquidation. First step, we sell what? Non-cash assets. Step 2, who do we give it to? Their partners based on their income ratios. Step 3, pay the liabilities, hopefully using what to do so? Cash. Yep. And then step 4 is what? Handshake right off into the sunset. Get their cash down and wipe out their capital accounts. Very good. 18 is C. When we sell things, it's called a gain or a loss on the realization, which is whose cousin? Who could we say that's cousin to? Revenue. It acts like revenue. Good. 19 is A. I see fair value, 280,000. Boom. B, realization. Yeah. Did I say something different? Okay. Take a quick peek at the answers.
Yes, excuse me for this interruption. There will be the fire alarm going off a couple more times. Please disregard the fire alarm. Thank you.
As we get to number 22, it's the 1, 2, 3, 4 step process. You really need to tell the cash story and, in my opinion, the T accounts, because it shows as the money moves through the liquidation where it goes. So on the test, I've given you T accounts. If T accounts confuse you and you have your system down and you know what to do, disregard the T accounts. You will not have points by using the T accounts. I just think it helps to tell the story. So if I look at cash and I look at the two owners, they all have balances going into this liquidation process. Cash is at 50,000? Yes. Sitting there at 50,000. Okay, Zoo had 112. Zirkle had 50. So as we, Zirkle, or however we say it. Okay, so as we start doing step 1, 2, 3, 4, remember it's got to go in that order. Okay, we had a gain, so we sold our non-cash assets for 265,000. Okay, so we got that money. Here's where that one came from. And so our non-cash assets are gone as a result, and we have that gain, which is like revenue. Okay, so as we go to B, we have to wipe out that gain. So here's the credit. We're going to wipe it out right away with the debit. And then as a result, we have to put that money in certain places. So Zoo and Zirkle get the 15 grand based on their income ratios, which are there. So this one's going to get +9. This one's going to get +6. Again, you don't have to do these, but I'm visual and I like to see where the numbers are coming from. So here we go. Okay. Then we're going to use cash to pay off our liabilities. Leaving us a balance of $177,000 in cash. And who gets that? Because we want to wipe that out. We want to like take cash away with a credit. We want to wipe that out. So there's our credit. So who gets the money? Partners. Okay. And away we go. We liquidate them as well. I don't need to see T accounts. I just think they're kind of a helpful tool. And it becomes a bit of forced math here at the end. Like the partners have to share that 177 based on their ratios. Okay. Cool? Go to our last page. You, of course, never have fill in the blanks. All right, so 23, a major disadvantage of a partnership form of organization is the unlimited liability. So in other words, the possibility of an owner not being in a bubble and having personal money subject to. Number 24, the income ratio specifies the basis of sharing income and losses. 25, the salary allowance or the interest on partners' capital are not expenses, but it is a form of eating up the net income. And 26, in liquidating a partnership, it's necessary to convert non-cash assets into cash and then allocate any gains or losses, which we know are a gain or loss in the realization. There were some icky ones down here in number 27. I would fully expect you to be like, did we talk about that? Let's rip through the answers though. Number 1 is B. Number 2 is J. Number 3 is E. Number 4 is A. I had that one starred, meaning we didn't talk a ton about that. Number 5 is H, liquidation. Number 6 is F. I believe the little exponent looking things mean that was part of like the appendix, which we wouldn't have talked about. So 6 is F. 7 is I. 8 is D. 9 is G. And 10 is C. Are financial statements of a partnership similar to those of a proprietorship? Yes, they are. They're very similar. As Ben already mentioned, you're just going to see double, well, I shouldn't say double, but however many partners are, that many capital accounts and that many drawings. So as I look at the test, you have no true and false, no true false. What's that? You have 15 multiple choice. Of course, you have a few little tough ones in there. Please know the order of liquidation. Yeah, the 4 steps. 30 points will be devoted to a partnership formation. 30. So Ron and Tip operate separate auto repair shops. They decide to combine their businesses into a partnership. So you've got one auto shop, the other auto shop, their values, their book values, but then another paragraph goes on to read, like, here's what they decide are their fair values. When we're forming a partnership, which contra asset doesn't come with? Accumulated depreciation. It gets kind of absorbed into the fair value. Which one does show up? Allowance for doubtful, and it needs to be a credit. Okay, so you are going to journalize the formation of the partnership. Then you are going to have a problem. I think you're actually going to like it. It's way better than doing a schedule. You are going to journalize the sharing of net income 3 ways. Yes, so I'm just telling you right now, the 3 ways, income summary is going to be debited by $90,000 every time. There's 3 or 6 answers really, because it's the account and the number. So as you do this, I'm just going to flash it really fast at you. It looks something like this. Okay. So they're saying in step A, or in time A, like here's what happened. You had a debit to the income summary for 90 grand. Then we're going to take the same person, the same people, only we're going to do something a little different. Income summary still 90,000. And we're going to try in the 3rd way. So in the first way, all you're doing is sharing the net income. In the second way, there is a salary allowance, and then whatever remains is net income. In the 3rd way, we're going to pay them a salary, we're going to pay them a percentage of capital, and then whatever remains would be shared based on the income ratio. So it's the same partners, Pella and Barry. In one, they're sharing net income. In the second one, they first start paying themselves a salary and then whatever remains. In the third situation, so there are 3 separate situations, all based on the same net income, all based on the same partners. In the third, they are sharing, first they are having a salary allowance, then the percentage of capital, and then whatever's remaining. Cool? Capital. And I will tell you, you will be at a deficiency. In that third one, you paid them too much. The partners got paid too much. So although you're sitting at a $90,000 net income, you're going to actually have a deficiency on that one. The last problem is a partnership liquidation. And I'm going to give you a little hint. You're going to have a gain on the realization. Would be no time to put a loss on the realization in front of you. Okay. Again, quick look. I've got little T accounts on the bottom if you need them. It says right down there, T accounts are not required for test points, but an optional tool if you need them. Now, unlike Friday, where I wouldn't have been here, I will be here tomorrow. I am not available before school, but I am going to be here during lunch if you need any last-ditch help. I'm not going to require you to take the self-test, but you have a lot of time. It might get you just thinking about some of those vocab terms one more time, so I would suggest taking the self-test. You don't have to send me anything. It's not meant to make you feel bad about yourself, but you would also see the areas that you're still a bit unsure about.